Today's Cardinal lesson, we're talking about how you can use IRA 401k money to purchase long-term care insurance. And there's a specific company that we use to do this, and have a lot of clients that have taken advantage of this. And the real juice here is that most people don't have enough regular money or money in a savings account, money in a brokerage account that they can liquidate to pay a $200,000 transfer of non-qualified money. If you have a bunch of money laying around that you could put into this, you could buy this single premium long-term care insurance by just paying in the money. You could skip a step in this thing. But a lot of folks have, for their retirement, in the example here, we got two people that are both 65 years old, a married couple, and they don't really have any plans for all of their IRA right now, and they're waiting till 73 to take distributions. So this shows them a way that they can just transfer some of their IRA money into this policy that is going to pay up a long-term care policy for the rest of their life. So I want to bring Tom on, and I want Tom to talk a little bit about why we're highlighting this particular product today.
Yeah, and so I think the why of this video is we really wanted to go into depth and show you how you can reposition your IRA money in a way that can give you lifetime benefits for long-term care. And so there's more specifics. We'll walk through the logistics of that. But the real reason we're doing this is the long-term care benefits at the end of the day. This is the largest risk you face in retirement. This is something that you can't predict, but when it happens, it's very detrimental to you and your family. And so we really want to show you how you can do this with using IRA funds. I do want to bring up the show notes here real quickly, and so you can find these at the link below on our web or the video. They're also on our website. We go through the board here. What I want to just show you is that the full illustration of this policy that we have on the board is down here below. Get into the specifics if you really are interested, or you can call us and we can run one for you. I will just point out these are for a couple who's 65 years old. If you're younger, you get more benefits. If you're older, you get less. So just this is just an example. But if you're interested, the full illustration is in the show notes. We've tried to simplify it for the board, and so we'll spend most of the time on the board on today's video.
Okay, so we want to stay high level today. And what we're going to talk about here is start in this first bucket is your IRA 401k in total. And this could be several places. It's just this bucket represents, and in the case of a couple, both of their IRAs. I mean, we're going to ultimately put this policy on one of them with their IRA, but it's going to cover both of them. So, and we have had cases where we've split up and we've sold them two policies. But for the purposes of the example here, this is going to include your whole balance of all your money that you haven't paid taxes on yet. That's there for your retirement. And a problem that people have with this, especially when they're in their early mid 60s, is most people don't have a plan to distribute this IRA money over their lifetime. And they just like to leave it there. And they even get bothered at age 73 when minimum distributions hit them that they're going to have to start taking a little bit out of there. And what we do with a lot of clients just in general is when we're meeting them in their 60s, is we get a plan for distribution that's going to start now, okay, or in the next couple of years, so that we don't have people getting into their 80s and 90s and then passing away and having a very large IRA balance. So this accomplishes a lot of objectives. So over in here, we're going to have the whole balance of your IRA. And in this example, we're going to, by rollover or transfer, tax-free transfer, we're going to take $200,000 of your IRA, and it's just going from one IRA or one 401k into another IRA that's at the insurance company. Okay, it's still yours, it's still on your balance sheet. It's just moved from there to here. And this particular IRA, this $200,000, is designed to be liquidated or distributed over 10 years. So, and it's currently paying a 5.34% interest rate inside of the thing. And that's how $200,000 to start out is able to generate 25 grand a year of distribution for 10 years, or that's going to total up to $250,000 that has moved over into this long-term care life insurance policy, which is the third bucket. So, if they were paying 0% interest, this would be 20,000 a year for 10 years. But at 5.34, it's exactly 25,000 a year for 10 years. And so this money is not going straight into the insurance company. It's going into your life insurance policy, which is developing a cash value. And this life insurance policy has a $225,000 death benefit. Okay. So how does that work? Well, if both of you buy this, you just move the 200 grand over, and then each year the 25,000 goes into the life insurance, and you complete that whole thing, and then you live on for some period of time, and then you both pass away and you never use the long-term care insurance, then your children or your beneficiaries are going to get 225 grand tax-free. Okay. Not real likely that both of you are going to go a whole lifetime and not use this sum. So let's take another example. Let's say that one of you uses it and you use it for 2 years. Okay. So it paid out 81,000 a year for long-term care, and it paid it for 2 years. So that's $162,000 that got paid out for long-term care, and then you pass away, then your beneficiaries are going to get about $60,000. So every dollar that's paid out in long-term care gets deducted from the life insurance benefit. So in other words, when this policy has kicked out 225 grand of long-term care benefits to either one of you, there's no more life insurance. There's only long-term care insurance. But the beauty of the thing is that this is a lifetime benefit or an unlimited benefit. So if you look to the future, if one of you developed dementia and needed care for 8, 10, 15 years, there is no tail end on this. So the insurance company is going to pay out this 81 grand a year for both of you for as long as you're alive. So this is a real high-end long-term care policy, all paid for with one single asset transfer of 200 grand from your IRA or 401k to this IRA. Okay. And one of the reasons they do this over 10 years of this 25,000 distribution is you don't want a tax hit of $200,000 all in 1 year. I mean, you're just that's going to raise your income by that amount. So in the planning that we do at IRA distribution planning for clients, we're planning this over their whole of their retirement and their lifetime. This is just a piece of it that starts early. And like I said, this money is not going out the door. This thing is going and building a cash value inside of here, which most likely you're never going to touch because you're going to carry this thing for your lifetime of both of you, because you don't know whether you're going to need long-term care or not. And then if it hasn't paid out the full life insurance benefit of long-term care, it's paid out nothing, then there's going to be this nice life insurance benefit that's going to go to your heirs tax-free. And by the way, the long-term care benefits that come out of this thing are tax-free as well. So, I mean, that's somewhat of an oversimplification, but I want to add a couple of points that are down here. Is the taxation is spread over 10 years, which I just said. And then this creates a phantom income for you. And by phantom income, it means it's an income of $25,000 a year that you don't see because the money is going behind the scenes from the IRA into the life insurance. So you're going to have a taxable, you're going to get a 1099 for this $25,000. for the 10 years each year. And we can add in a tax withholding so that you can not have to come up with this out of other money. So you can pay for it with IRA money. There's lots of different ways we can configure this. Um, so I want to bring Tom on, and I want Tom to talk about a little bit about how we use this or can use this for beneficiaries of IRAs.
Yeah, so I think one of the unique sort of situations where this works really well for is when you are a non spousal beneficiary of an IRA. So this is generally a child, a niece or an uncle or aunt has passed away. Somehow you're coming into some IRA money that's not yours. The IRS or the Congress passed the Secure Act a couple of years back, which changed the rules around how the distributions need to be handled. We have other videos on that. If you have questions on that, you can go look. But in summary, you have to distribute this IRA over 10 years, and that account has to be emptied by the end of that 10th year. What this policy works wonderfully for is just from the structure is it is a way it's designed to be emptied in the 10 years. That annuity, that middle box on the board is the IRA. You can do an inherited IRA and it gets distributed over the 10 years and it's that bucket is empty. It's been moved to the life insurance policy, so that money is still on your balance sheet. It's still yours, but it's now provided the long-term care benefits, which you didn't have. It's distributed the IRA according to the Secure Act rules, what the IRS wants you to do. And now you've met those requirements. You've given yourself the benefits of the IRA. This is money you didn't have previously. It's a wonderful way to use it. Now, I will point out that for this to work in your situation in this particular design, it needs you need to have inherited the money either this year or last year. It needs to be within those first 2 years, just around how the structure is. But if you're a couple years into this, there are other things we can do to design a policy very similar to this using IRA money that maybe only has 5 years left on the distribution window. So if you're in that situation, call us. We can help design a policy that's going to work well for you. I do also want to make the point that really, when we look at using this in terms of someone's financial plan, sort of the client, the breakdown of the client that makes sense for this is we have a lot of clients that have these big IRAs, these 401ks that they don't really need to live off of. And so they're sitting there, they're not spending it, they're maybe just taking the minimum. We want to do tax planning anyway, so we want to have some distribution strategy. And we sort of asked them and we sort of surveyed them, why aren't you spending any of this money? They said, well, I might need it for the future. And we sort of look at their situation and say, well, what are you going to need this for? You don't need it to live on. Your income is covered by these other sources. What do you mean you might need it? And when you really get down to it, they might need it for care. That's really what they're worried about. So if that's you, why don't we do it in a better way? Use the leverage from the insurance company that provides lifetime coverage that can never run out and have it all guaranteed. That frees you up to enjoy maybe your other funds where you're not as worried about spending it because you've covered the risk of long term care.
Well, yeah, and tax-free benefits. I mean, yet people that just build this big balloon IRA and then they've got minimum distributions going on, they get in a high tax bracket in those later years, and then all of a sudden long-term care hits them, and the place they're going to go is to the IRA. That that's all taxable money that they're using to pay for that long-term care. This alleviates that problem. So we want to talk about how this fits into your whole financial picture and the 7 worries. So we can start out as this whole subject is long-term care. Is there the prize here? What we're going through all this rigmarole for is we want to have this single premium, paid up, never can get a rate increase, long-term care life insurance policy. That's the prize, and so we got to go through all this planning to get there. Um, the 401k IRA this is pre-tax money, and we need to turn it into post-tax money before we use it for long-term care or we pass it on to our heirs. So this whole distribution strategy can be part of a larger IRA 401k distribution strategy. When we talk about income, that's what the whole business that we're in is taking IRA 401ks and producing an income for life. Estate planning really is you want to be passing to your children not tax or not mortgage money or tax mortgage money, which is what an IRA is. when you die and you pass that on to your children, you're passing them a tax debt. This thing, the life insurance piece, gets paid tax free as life insurance, not an IRA. And then, obviously taxes, we've been talking about them the whole day. So I want to bring Tom back on. I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening.
Thank you.